Welcome everybody. This is the Rundown with Rob and Rich, our bi-weekly look at all the latest happenings, news, rumors, speculation, things going on in the mortgage industry. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as I am every episode by Rob Krisman. Rob, good to see you.
Nice to see you.
In St. Croix this week. It was Alaska 2 weeks ago. It's been several different exotic locations. And this week, again, special guest host, the founder and CEO of LBA Ware, one of the technology pioneers of our industry, a good friend, a fan favorite within TMC, many happy TMC clients, Lori Brewer of LBA Ware. Lori, thanks for joining us.
Glad to be here. And it's Friday. Yay.
And at the outset, it is Friday. At the outset, Lori's company, to level set, what they do, LBA Ware, signature product they've had for a long time now is CompenSafe. It is incentive compensation management software. Many TMC members that are using it to manage comp for their LOs, even operational employees, and a business intelligence product by the name of LimeGear. And LB, I've been hearing some good things from our members about LimeGear, including some new closer capacity module function that's part of it.
That's right. Thanks, Rich. We're having great success with LimeGear, adding a lot of dashboard screens, reporting, basically visualization of your data. So if you're using the Compass or using PDFs or emailed spreadsheets, please give us a call. We'll at least show you what we're doing. And the latest is a screen that takes all the loans that are going to close this month or next month and graphically shows it on a calendar, and also the capacity of who those loans are assigned to in the closing department. We're doing the same thing at the underwriter's point in time also. So you can get a really quick visual of who has the most loans and whether we're going to have a heavy Friday, heavy Thursday. So playing with a lot of insights based on feedback from lenders that need to manage the heavy production heavy production going through the manufacturing process to try and close things a little bit faster and more efficiently. So having fun with that.
Awesome. And business intelligence software in general. I want a lot of stuff I want to get to today. MBA did a town hall with their members yesterday that had some interesting info in the Q&A portion at the end of it. We recently did a survey. I think I briefly alluded to it on the last rundown because we were just kind of getting the results in, but biannually TMC, we do a survey where this went out to 600 key decision makers from our 234 lender members, taking their temperature on all the most pertinent industry issues. I want to go through some of the things that came in the top of that survey, a lot of which have to do with staff retention, employee productivity, the whole work from home dynamic and some of the things that have spawned from that. So Lori, I'm anxious to get your feedback on some of those topics as we get to that point of the discussion. So, all right. So getting things started here in the news, we're still waiting on the Supreme Court decision on the FHFA. Bob Brokesmith alluded to this yesterday in the NBA town call. They said if not this week, likely next. I think it's one of the next cases up for the Supreme Court. Interest rates, inflation, another high inflation number that largely the bond market and stock market kind of shushed off. Just, a lot of stuff in the news about just the dearth of supply in the industry. But FHFA, the current version, plugging along as if nothing has changed. Rob, did you read the entire 142-page FHFA annual report that they released a couple days ago? That was your homework.
About half through.
You're halfway through. So it's very aggressive, like some of their policies. But any from your end, Rob, your inbox, obviously you're interacting with a lot of people. Anything of note this week that's kind of come in your inbox to get us started here outside of the,
Oh, well, sure. There's two big things, Rich, going on in my inbox. It's kind of a little bit of a personal question there, but I'm used to that from you. The first is the fact that the FOMC comes out with, their meeting discussion on Wednesday, and suddenly everybody's running for the hills. And I think it's important, and we, it was a total knee-jerk reaction, which, isn't surprising given some of the investment banks or traders or the mentality, where the Fed has come out and basically said, not a whole lot new, really, but the Fed is aware that inflation may pick up, and the Fed is aware of this and aware of that, and so forth and so on. I think it's important for viewers to remember when they're look at what's the activity from that and the rest of the week, is that a lessening of a lenient policy, taking the foot off the gas a little bit is not the same as tightening. Everybody just needs to take a breath. And sure enough, we saw this knee-jerk reaction. Rates went up. MBS prices, current coupon MBS prices, sold off about a half a point, I think, Wednesday afternoon. And then we gained most of it back yesterday and into today to some extent. And I think that the Fed wasn't saying anything new that we didn't already sense or haven't already talked about. And that is, if and when the economy starts to pick up steam, the Fed is going to stop buying, $5 to $10 billion a day of mortgage-backed securities, which they weren't doing years ago. And the fact that they're talking about that, and that is an option and a viable option, suddenly everybody said, oh my gosh, look what they're talking about. But we've been talking about that for months. So it wasn't surprising that the interest rates did what they did the other day. I think we'll settle right back down again. It's not like there's a new normal. It's not like anything exciting has really happened with the Fed, with the Federal Reserve, the Open Market Committee. And then the second thing is, I'd say about a quarter to a third of my emails today have been regarding the flippin' Juneteenth holiday. And I don't mean flippin' in the declaration that it's now a national holiday. It is the apparent curveball that has been thrown to compliance people and processors across the nation about, suddenly there's a new holiday tomorrow, and what are we going to do? Does it count? Does it count? Does it not count? What are we going to do about our locked pipeline, so forth and so on? And I published what I knew as of this morning. I haven't seen anything since then that that differs from that. But the interesting thing that people are talking about is the lack of policy, published policy by the Consumer Finance Protection Bureau. Even the American Bankers Association sent out a note an hour or two or three ago saying, we're trying to get in touch with the CFPB to have them issue some kind of, overall policy, and nobody's heard anything. So I think that's interesting. And in the meantime, there's a lot of details that need to be sorted out, but it's a holiday. And I think, Wells Fargo sent out one or two sentences to its correspondence clients saying, it can't be counted and let's move on. Just like, Christmas Day, or just like Thanksgiving Day, which is kind of, cut and dried and straightforward, but still there's the devil's in the details for a lot of compliance departments out there and so forth. And nobody, of course, wants to make a mistake. I seriously doubt that a lender is going to end up in a class action lawsuit because they did something slightly wrong during this time period, especially without guidance from the CFPB. But those, Rich, are the two big things that seem to be lighting up my emails these last few days is the market and Juneteenth. It's kind of hard to say. Juneteenth and its implications.
Yeah, our member engagement team has just been getting a slew of emails over the course of the last couple of days about Juneteenth, and just the fact it is a federal holiday and how it impacts their business, and yeah, lack of direction from CFPB or really anybody else on it. I know MBA is trying to get answers as well, so a curveball that was thrown here this week. So, and then Lori, so I know you recently hosted a call with the MBA IMB group. They wanted you to talk about staff retention, and that came up. I'm going to try to share this here. We recently.
Hey, while you're bringing that up,
Oh, look at that. The
stupid question.
multimedia presentation.
Beg.
We're very tech savvy. Yeah.
Well, go ahead. Yep, that's awesome.
Yeah, real quick, this is just the background. This was sent to 598 key decision makers. That's just kind of the breakdown. 54% were from IMBs. The mix between small and large lenders was pretty even, as was the mix of IMB and depository, all kind of key decision makers. And basically, we threw what we thought were the 40 most pertinent issues in the mortgage industry to them and asked them to tell us how important are these issues to you right now, from critically important to not important at all. We obviously tallied and weighted the results, and this is what came back. And just some commentary that I put together. There were 6 that kind of stood out above the rest that we'll go through here. But number 1 was retention of existing staff. Lori, you are as dialed into the compensation and employment world as anybody in our industry. What are you hearing from clients? Our members are basically, essentially what they're saying is that, the whole work from home thing, it made their employees now hireable by anybody in America, and vice versa. And, also wanting to understand, as business has contracted, obviously from last year, who their most productive employees are, who the ones that they want to retain, and, everything they can do in a remote or partially remote environment to create and still maintain the company culture that will keep good employees at their company. But what have you been hearing out there, Lori?
I think this is so interesting right now. I don't know if you guys feel it. I think Rob feels it because he's been going from Alaska to the islands, but the post-pandemic, roaring 20s, there's a new energy out there, and especially with our workforce. And there are all these new acronyms, YOLO, you only live once, work from home and remote work, I found out, are not exactly the same. Home office versus I'm going to just be mobile and move around and do my YOLO stuff and work from anywhere. So WFA, the great reshifting, the great reopening, all of these terms. And Wall Street Journal had an article on people are not just changing jobs, they're just leaving their jobs. So there's a little bit more money in people's pockets. They're feeling good about the future, and they're deciding to make a change in their life. And that is impacting a lot of businesses. And I don't know if the crowd on the calls now is feeling that, but I've talked to several companies that are feeling it. And I've interviewed, especially software developers are interviewing with me because the company they're working for is planning to make them return to the office, and they're not going to. And the other thing I've picked up on is if you've been in a market that's been somewhat isolated, it's not Silicon Valley, it's not New York City, it's someplace like Macon, Georgia, you're not isolated anymore, because the entire outlook of people working from anywhere for their dream employer is just so much, such a wide open opportunity now. So it's interesting. And then that's affecting lenders who have really hired and worked hiring underwriters lately and doing sign-on bonuses and paying up for people. And we had done a study that showed over the last year, our clients had hired 60% more processors. May have mentioned this on the call last time. 60% more processors in the last 12 months. So that is, not quite doubling down on your processor staff, but that is a lot of new humans to be responsible for in your company. And then, so what I'm hearing and being asked is, how can we see things as far as the activity that individuals are doing it? Here I'll share, or tracking what folks are doing on the LOS on a daily basis, because you always want to trust what folks are doing, but you also want to trust and verify. So it's interesting because we're in a kind of in a new world, I think, going forward. It's not going to go back to normal. That's not a new surprising statement, but it is definitely going to be different.
So Lori, I want to ask you, when I talk to CEOs and managers and so forth, have you noticed a sea change, for lack of a better term, in terms of management skills that are required to manage people who are working out of their van in, South Carolina versus, an office in Kansas City? Is it a different set of managers who are required? Are managers having to retool? How do they monitor all this, and how do they effectively manage their workforce when it's scattered around the nation?
Yeah, great question. I think people are kind of grappling with that, because, well, and I think it also comes down to, as a company, what you are putting in place as your return to work policy, if you're going to have one, or are people just going to be measured on their output, and do you have a way to measure their output? It's challenging because you can't just walk by their cube anymore and see that they're there at 4:50 and still working on files. So I think it's a challenge that's not going to go away. And also coupled with that is the fact that a lot of lenders have grown their staff just significantly. And so now this will give us all the chance to kind of look back over the last 6-12 months and reassess who you've brought on, because some of your new folks might be doing better than some of the others. So it gives us a chance to reset, but at the same time, everyone needs to expect that there's going to be a lot of people hopping.
It's definitely a new world order. I read that Wall Street Journal column, and I forget the number. I think it was like 20 or 25% of employees said if they had to go back to the office, it would be a non-starter for them, which I thought was, interesting, to be sure, because people are divided on it. Some want to get out of their house and get back to the office. Some feel like they can't return to the office based on just their affinity for working at home or how it makes their life easier. And if you go back to the survey here, number one was retention of staff. And again, this is a cross section of 600 key mortgage leaders, decision makers across America, 40 different issues we threw at them. So, number three was scaling and modernizing your loan manufacturing process to insulate against volume fluctuations. 4 was measuring operations employee productivity. And I could just tell you from the round, we just did a slew of collab labs. I think we did 8 virtual collab labs and like 3 in person recently. And all these labs are talking about the same thing. Like last year, everything was wine and roses, loans are flowing in the door, you're making gobs of money. Everybody's so productive working remote. This is great. Why didn't we do it before? Now you still have these bloated staffs. Volume has come down a little bit, and leaders and business owners are very consumed with how productive their people are at home. A lot of these people haven't even met yet that they hired that are working from home. Volume has dropped. They're probably carrying too heavy an ops staff right now. They're starting to think about, if they haven't made already, some adjustments or cuts to staff. and they're talking about products that monitor productivity at home, products that, like business intelligence software and other for specific for, the mortgage industry, and other products that can tell people like, what website, when they're logging on and off, how much they're on their computer. So it's a very interesting dynamic right now.
And that is hard. And the minute you implement some of those products, if if you're looking at that, make sure you Google also how to set your computer to show that you're online, because as many tools as there are to show you're online and working, there are probably just as many, if not more, to cheat those systems. So
I actually left the call 10 minutes ago.
we need some tracking software for Rob. Yeah.
Yeah. Well, Rich, the ankle bracelet over here isn't doing the trick.
I mean, we have the blood alcohol content monitor already, but it seems like we might need to ramp that up a little bit.
well, he's not in a bar this week, so.
But so amongst lenders, I would say, like, and this is just total like spitballing, like 10 or 20%, in my opinion, are already using some of those products at home to kind of monitor, and then there's a big chunk that are interested in them. And there was a lot of discussion about this in all the labs. And then within that, the ones that are using them, some are using products that they tell the staff we're using them. And then some are more behind the scenes, like, the employees don't know that, the tracking software is in place. So it's going to be interesting to see how this all plays out with the work from home dynamic. Rob, your hand is up.
Sorry to interrupt, but the thought, Rich, when you get old, you have to blurt out thoughts. Otherwise they vanish into the netherworld. Are you hearing from your members? And I'm kind of getting into the weeds here a little bit, but I've been asked once or twice regarding the caps that are now on, whether it's 3%, whether it's 0% or 3% or 7% or whatever the cap is for non-owner occupied and second homes. Do you have lenders asking you about compensation, or maybe Lori's heard this, compensation for LOs who specialize in that kind of product? And because now the company has a cap by selling to Fannie Mae or Freddie Mac, those loan officers can't achieve their full potential because the company's being capped. Have you heard any rumblings like that, Rich or Lori? Lori, your hand is up.
Lori?
Well, question on that. And this is a stupid question, but you guys are going to know it. So if you're capped at 7%, and my understanding is the math figuring out, it's not like straight line 7%. There's nuances underneath there to get to that 7. And if you're have over delivered, those are the people that are being now possibly lowered to 3, right? And then I saw Inside Mortgage came out with something that Wall Street is loving this, because that activity is now going their way. So are you saying product and pricing is going to increase more so just because of where the product's going to end up landing?
Well, what is happening is, as Fannie Mae and Freddie Mac, at the direction of the FHFA, have constricted or shrunk their footprint, whatever you like to call it, whether it's caps and sales to the window, or whether it's, APR calculations, or whether now it's non-owner and second home caps. So yes, the non-QM investors are licking their chops, as I like to say, as my mom used to say. And the private label securitization industry, the marketplace there, is also excited about that. And you're right, the investment banks are anxiously awaiting an inflow of product, because I think everybody on the call will tell you that much of this second home and non-owner property lending isn't of a higher risk. And so what banks are already doing is saying, okay, if it's a low loan to value non-owner loan or a second loan, a second home, or the borrower has a low debt to income ratio or a high credit score, we are going to put that in our portfolio. We're not even going to show it to Fannie Mae or Freddie Mac. We're just going to put it in our portfolio, and it won't show up on our numbers that Fannie Mae and Freddie Mac watch. The bigger lenders, the AmeriHomes, the PennyMacs, and so forth, are at an advantage. But like Loan Depot has an entire department about securitization, so they have the capability to securitize huge swaths of, Freedom or Loan Depot or United Wholesale. They can securitize those kind of products, but there's a cost to that. And if you are a Loan Depot, is your focus going to be more on your retail origination and securitizing that, or are you really going to help the broker? The same with other companies that might have a correspondent arm or a wholesale arm or a retail arm. The question is, where do you allocate your resources, and how expensive is it to securitize that product? What kind of yield are you going to see? So great. You're able to send $200 million of second homes or non-owner occupied loans to Goldman Sachs to bundle up and put into a security. Well, Goldman Sachs doesn't come cheap, first of all. And second of all, I think the investor demand should be pretty good, but we don't know. And right now there's this period of uncertainty that lenders are saying, where am I going to price this stuff? Because the quickest way to turn off something is raise the price. But Fannie Mae and Freddie Mac didn't just jack the price up. They put a percentage cap on it. It's much harder for capital markets staff and CEOs to manage to some kind of percentage versus some kind of price hit that they can automatically put on their rate sheet. So now they're dealing with this percentage, and it's somewhat nebulous and so forth. But so you're right, there are other outlets, but it's going to take a while to sort itself out. And it's almost kind of like a moving target. It's almost like trying to pick up a jellyfish. Like you might pick it up here and it flows over there, or vice versa. It's very hard for capital markets to price that on a rate sheet and price the risk into their overall portfolio of originations, because it's a bit of a moving target. But I was wondering, Lori, more on the loan officer side. You're a company in some part of the nation that really focuses on non-owners or second homes, and you have originators who, 50% or 70% of their book is that kind of business, and you've just got hit with a cap. What are those originators? What are you hearing about those originators? What can they do, if anything?
Someone just posted in the chat, they are hearing fellows jumping ship. I personally haven't heard anything. Ari Karen would say, how close to the fences do you want to play? But if it's a borrower coming in who wants to buy an investment property, you're probably not going to sway them, or if they're owner occupied, you're not going to sway them on a different occupancy type. So it's not just like purpose, refinance, or purchase. If you chose to go this route, I'm not an attorney, but it's not, you could tie comp to occupancy if you're not influencing that decision. Again, that's for your legal counsel. I have not seen people putting that in place, even though you would think possibly folks would want to look at doing that. So yeah, you would think you'd see it. But on the other hand, what was the percent of, does anyone know what was the percent of second investment prior to this cap? And why are all of these changes thrown out like day of or day before, like the holiday?
Yeah, there was no cap per se. In fact, Michael Ehrlich did a good study about what actual numbers look like percentage wise that were being delivered to Fannie Mae and Freddie Mac for second homes, non-owner occupied. And of course it varied by lender, but probably the most, as I recall him saying, was that some companies were delivering upwards of 15% of that kind of product to the agencies. So they've really gotten scaled back. But as you point out, some lenders haven't heard anything. And so they just thought that they are well under that 7% cap, so they can just go with the 7%. But yeah, it varied. But I know that some originators in some areas, like if you're an originator in Vail, Colorado, or let's say you're an originator in Miami Beach or something, and there's a huge condo market or a huge second home market, and not so much condos, but non-owner, whatever might be investment properties. It just seems like as an originator, if I'm working for a company that is now has a 0% tolerance or a 3% tolerance, it's going to cause me to it's going to cause me to, I don't know what it'll cause me to do. Maybe look around a little bit. I don't know. Maybe that's a new recruiting technique to be able to lure originators, is that, hey, we're not, we didn't get any bad messages from Fannie or Freddie on our caps, so come on over. I don't know. Be interesting.
True.
And it
True.
may be moot. The one thing I wanted to bring up was the MBA does a town hall with their members, and listened to it yesterday. The Q&A portion at the end was interesting. There was some things that Bob Brooksmith brought up that I thought were interesting. One was he expected HUD to make an announcement around FHA qualification, forgivement of, or something regarding student loan repayment, as something he saw was coming. He got a question about FHA insurance premiums being reduced. A lot of people thought Marcia Fudge may do that. When she was appointed, she immediately kind of made a comment to saying they wanted to see how forbearance played out. Brooksmith seemed to think that when the latest actuarial report, because home values are up and delinquencies are down, non-forbearance delinquencies, that when the next actuarial report came out in November, he felt like there was a very good chance that HUD would reduce FHA insurance premiums, which to me, I thought was big news. And I see somebody put in the chat that FHA issued a letter today regarding student loan payments. He got asked about home equity lending. Have you heard anything about a clamp down there because of all the run up in values? And if they're reversed, that he said he hadn't heard anything, and that the banks do a lot of that lending, and that he expected the banks to, regulate that. He was asked about the supply shortage, said basically we got nothing there, no help. He was kind of punted that one to NAHB, the home builders, he said, which are working on it. And then regarding FHFA, he got a couple questions on that, the Supreme Court case. He said a couple interesting things. He said, one, if Biden's allowed to fire Calabria, he will immediately, most likely. And he mentioned Sandra Thompson, who's the current deputy director, as the person he felt very good that would be appointed as the interim. He then mentioned that DeMarco served like as the interim, never had to go through the appointment process for like 5 years. Then he got a question like, did he think that Sandra Thompson would be in that same kind of category? And he said no. He said that he felt like the Biden administration was already was well down the path of pursuing permanent replacements, and would look to have somebody go through the formal appointment process, and that Sandra Thompson would be there for months in the position and not years. So just some interesting tidbits from the MBA town hall calls.
Hey, Rich, do you, since it's just us girls on the call, as they say, do you get the impression that the NBA is reacting or acting when it comes to some of what's going on with the agencies, whether it's Fannie or Freddie or FHA or VA and so forth?
Well, you know me, I tell it like it is. And we need them desperately in our industry, because nobody likes mortgage bankers, and they have been a strong advocacy voice. But I do feel like, it was a little crazy. The PSPA amendments came out January 14th, and then almost, acted surprised when they started implementing these things that were in there. To me, that was shocking. I know it was shocking to a lot of our members. So I think they were just so happy that they formally stopped pursuing like getting the GSCs out of conservatorship, that maybe they took their eye a little bit off the ball about some of the things that are now happening, that would still, put them on that path. And so, yeah, so I think that, and part of it is like Calabria won't talk to them. I get it. Like, if Ed DeMarco, Mel Watt, other heads of FHFA, MBA has always had a great working relationship with. And, the current director basically won't even talk to them. So they're kind of behind the 8 ball a little bit. I get it. That said, I think there is definitely merit to the reacting and caught a little off guard part of it. So,
All right. So Lori, sorry, I'm gonna loop you back into the conversation because I don't think we're not done with you yet, young lady. Getting back to the different management skills that might be involved from a work from a Volkswagen van, or work from home, or work from the office, and so forth. Where do you see your product set? How do you see it evolving for the remainder of the year, especially Comp and Safe? How does it help a remote manager, and how might it change as the year goes forward?
So we're seeing more and more examples of lenders using Comp and Safe to set up quality metrics to go in combination with quantity metrics. So if you combined, for an underwriter, number of initial decisions made. Well, let me give a processor or a call center LO example. We see lenders using, for example, call center LO for with a capacity metric along with the number of calls they're doing. So that to me is interesting, because hey, if you're somebody who can be more efficient at your job, and if you set up the success metrics of what I need you to do in this role, and they can hit it, so be it. Go have a glass of wine at 4 instead of 5. And that to me is interesting. If you can do it successfully. It's of course very hard to set up quality metrics if you don't have clean data. It all goes back to making sure you have clean data, clear math around how those metrics are put together, because the worst thing to do is mandate something that you lose the trust and transparency of your staff. None of us like that. So, but if it's simple enough to be understood, and simple enough for people to understand how to succeed on those metrics to make a bigger bonus, that's pretty awesome. And then you don't have to be as hands-on. You don't need that tracking software.
Yeah, that's almost like the holy grail, what you're working on there, or what you're offering in terms of your product, because it's always important, I think. I'm stating the obvious, but I'm just stating it for the heck of it, to tie in your employees' goals to that of the company. And it doesn't matter if you produce a lot of loans and get paid a lot of money, if your delinquency or foreclosure rates are high, or it bogs down processing, or it messes up the warehouse line because it's whatever. So to be able to go back to the originator and say, here are the goals of the company, here's how we make money, here's how to keep the machine flowing. And so, I think you nailed it. So I think it's very, very important.
The other thing we're working on, I'll just say really quickly, is just more visualization from the branch manager, regional manager perspective. Found out like a lot of those folks don't even have it. The company may use the LOS for a lot of its pipeline reporting, but regional managers or non-producing branch managers don't always have an LOS login, or if they do, they don't want to necessarily use that as their reporting mechanism. So doing some interesting things there.
This is the Rundown with Rob and Rich, this week joined by special guest co-host CEO of LBA Ware, Lori Brewer. If anybody has any comments, questions, thoughts before we depart, this would be the time for them. Lori, you have a question?
Yeah, what do you guys think about housing prices? I've been watching, and
As somebody that bought a house, I hope they keep going up.
like
I
even Airbnb, you can barely get a home, and if you do, you're paying for it. And then if you look at what those houses are selling for in places like on the beach where I've been searching, I swear they're going up at just a gigantic run rate of that sales price, and people are paying it. When's that going to slow down?
you know, I think that we're going to see we're in the midst of seeing a major correction to housing prices in America, just based on supply and demand. It's just have not built enough homes in America as of late. The last year and a half, it's been even more delayed because of, one, the pandemic, and then two, supply prices of supplies are starting to fall right now. I know that some of the big home builders have come out this week and said they're ready to put their foot on the gas pedal now that supply prices are coming down. So I think you're going to see a lot of building. The last couple of years, you're going to see, I think, unprecedented amounts of home construction. But it's going to take a long time for that stuff to work its way into the pipeline. And I just can't see any scenario where home values like start dropping, because you have so many people that want homes, some that need homes, and there's just not a lot of houses out there. And I think that home prices are going to keep going up for like another year and then won't go down, would be my guess. So
Rich, I agree with you. I've been saying it all along. I mean, millions and millions of people are turning, 30, 31, 32 every year that want to own a home, that can't find a place close to a city center. So, I mean, and you've got immigrants coming into the country. You have the government, beating on the home ownership drum. The demographics just don't point to any kind of housing deflation. Of course, we're sitting here saying that. It's like, Kennedy asking the shoe shine boy right before the stock market crash, oh, you like stocks? Oh yeah, stocks going up, whatever the shoe shine boy supposedly told him. But I just don't see it. I think the demand is there, and unlike stocks, people need a place to live. And yeah, you could say, well, they could live in a rental or live in an apartment, live in their van, but people still want to own a home. They want their kids in a good school district. They want to throw the ball for the dog on the lawn, kind of thing. So,
and I think in general, like in America, you had seen over the course of the last decade more of a movement of younger people and people in general moving into the cities and urban areas. I know in Cleveland, like nobody lived in downtown Cleveland until like 6 or 7 or 8 years ago, and then it's been a big initiative, and a lot of younger people I know live downtown and love it. But I think now, I think the value of a home has just generally been swelled due to the pandemic, number one, and two, like the whole suburbs and schools and that thing. Like some of the millennials I know, they thought it was so cool to live in the city, are now like, no, it's, I'm gonna find a nice little suburb 20 minutes outside the city. I can go into Cleveland, see the calves of the Indians, and Uber in for $20 as opposed to living there. So Rob, we did have a question come in. It was asking about speculation about the next HUD undersecretary or FHA commissioner. Have you heard any rumors? Nothing? Yeah, I haven't heard anything. I think
no,
everything's just waiting on this FHFA thing before any of that starts to get any momentum.
yeah, I remember when Trump took office, a lot of folks pointed to the number of unfilled positions as the months went on in the new Trump administration. I think a lot of us who have not been in government don't realize how long it takes and what the political process is for some of these appointees to be put into positions of power. And we're seeing that with the Biden administration, same thing. But given what President Biden has talked about and the vice president, given what the other administration appointees are like, we'd expect it to be very pro housing, affordable housing and so forth, trying to promote business and pro-government. Frankly, the role of the government doesn't seem to be diminishing with this administration. So, but I haven't heard any names bannered about.
Any other questions, comments? Pump them in the chat or the Q&A right now. We'll sneak them in before the end of the show. But wrapping up here, LB, any last thoughts on the state of the mortgage industry as we head into the heart of summer, and anything to leave us with here on the rundown?
Lori?
People are traveling, and I think that's good. If you've been on a plane recently, it's back to normal.
Packed.
Just packed.
I know I go from here to the Florida Mortgage Bankers in Orlando early next week, and I think they have approaching 250 registrations. So
wow.
Great turnout.
Yeah, so I think everybody's going to be taking their vacation and going. National parks are apparently overloaded. So lots going on. It's going to be an exciting summer. Never boring in the industry.
You posted a picture, your crazy hiking trip. The one picture you posted on LinkedIn was incredible.
That's right. That when we did this call 2 weeks ago, I was just heading out. Yeah, we did multiple hikes above 10,000 feet in the snow, but in our shorts because it was Groundhog Day, mid 80s every day. Beautiful Colorado, blooming green. It was amazing. It was fantastic.
Rob, are you in St. Croix for the weekend? How are you going to spend the weekend in St. Croix?
Hiking and in the water.
There you go. Nice. LB, any plans for the weekend that oh boy.
Oh, there we go.
I always say I'm just one Amazon delivery away from this show going off the rails, and that could have been it right there. So Lori, your weekend while I go on mute.
All right.
My weekend consists of helping take some items that are needed in a dorm room up to my child. You have to have the big poof, the big beanbag. It's critical.
All right. Well, Rich is having a sidebar conversation. I guess we'll log. Oh, no, now Rich is back.
Yeah, sorry about that. My dogs are idiots.
You need to change to cats, Rich.
I know. Well,
Not as loud.
I know they're
right, Rob?
They're easier. Yeah. So to be sure, but yeah, my girlfriend is out of town, so she left me with 4 dogs. And I never even owned a pet in my life until like a year and a half ago. So they're winning. Let's just put it that way.
All right.
Excellent. Once again, as always, great discussion, Rob. As always, good seeing you. Always interesting to see where you're going to show up from. And 2 weeks ago was a bar in Alaska. Today it was St. Croix. But always enjoy your participation in the discussion, Rob. Thank you.
Thank you.
And Lori, LB, always good to see you. LBA Wear, Comp'nSafe, Lime Gear. Again, anybody that's interested, get a hold of Lori, myself. What we do is we connect you with members of ours that are clients. It's one of the a benefit of membership at TMC that you won't find on our website, but hey, we're thinking about using LBA Wear, Comp'nSafe. Can you connect me with a few members? And unlike what a lot of vendors would do, and they'll just connect you with the 3 people that say, oh yeah, say nice things about us. We are doing that every day for our members so they can make smart decisions before they start doing business with a third-party provider. Talk to people who have no MO other than to help out a fellow member. But Lori, that's been a big part of your growth within our network and success is just our members loving you and your cool company. So
yep, we've had
I agree.
Very little to no churn on Comp'nSafe ever. So speaks to the success that we've given clients. And thank you, Rich, for always mentioning us.
Absolutely.
And yeah, everybody knows where to find me, lbaware.com. So reach out. You never know where to find Rob, but
I'm an email away.
Right. So
all right.
All right, excellent. Well, have a great weekend, guys. For our attendees, thanks for spending part of your Friday with us, and we'll see you back in the same spot 2 weeks from now, 3 p.m. Eastern, on The Rundown with Robin Rich. Have a great weekend, everyone. Take care.
Bye, guys.
Bye.
Bye.